In case you're wondering, I did not buy into the SpaceX IPO. I hope you didn't either. It's a terrible company trading at almost 100 times revenue when it went public. Not 100 times earning, 100 times revenue, which is ridiculous. However, if I did want to, there was an easier way to play it than to beg my broker for an allocation. You could have gotten it pre-IPO prices if you wanted to and you thought about it hard enough. And I didn't post about it before because I didn't want anyone doing it on my recommendation if I wasn't doing it. But there was a way to get the pre-IPO price if you really thought hard about it. So what do I mean by that? If you look at the Barron Partners Fund, it's a very concentrated fund that had about 25% of its market cap in SpaceX shares pre-IPO. So as of May 31st, which is a few days before the IPO, they said they had about 25% of their shares in SpaceX and 5 or 6 other companies. And if you deducted the price of the other companies from what the fund was trading at, it would have given you a valuation for SpaceX at 1.25 million instead of 1.75 million, which was the IPO price. So therefore, if you bought that fund, you would have gotten SpaceX shares at 40% below the IPO price and gotten a 20% bump on the day that it issued. Now you might be thinking, okay, well that's 25%. What about the 75% of the other shares in that? Well, what you could do, since there were not that many shares, different companies, it's very concentrated, you could buy that short the 6 or 7 other companies that make up 90% of the fund. And then you'd left with a pure exposure to SpaceX shares at a price that was 40% below the pre-IPO price. Then when it went public, you could have sold the shares in the fund, closed out your shorts, and collected your profits and gone home. So before I early retired and decided to make YouTube channels on investing and other things, I was a finance lawyer. And early in my career, I did mergers and acquisitions, including a merger for AOL Time Warner, which was the largest merger in the world. And as a transactional attorney, I always thought that if you're a good transactional attorney, you can draft your way around any problem that doesn't involve a hail of bullets. And so when I thought about, well, how would you get uh, pre-IPO exposure to SpaceX? This was an easy way. I didn't do it because getting SpaceX at a 40% discount when I think it's 500% overpriced doesn't appeal to me. And there are other situations where I've seen the same thing. There was a South African company, Naspers, that owned shares of Tencent that you could buy at a discount if you add up the sum of the parts. But the problem was that at the time I looked at it, it was overpriced. There's a company called Grupo Televisa, which owns a Univision in the US. And if you add up what Univision is worth and deduct it from the rest of the assets of Grupo Televisa, you're getting the rest of it for free. But there's the problem of the pickles are in the jar. How do you get the pickles out? And there was a company, Bausch Health, that had 80% of the shares of Bausch and Lomb. And then, also if you added that up, you're getting, based on some of the parts, something for free, right? So there's always situations like that. But the problem is that if you are not faced with a coming IPO, you can get those hidden assets at a discount, but they're trapped inside the company whose shares you bought. And with the SpaceX IPO, because it was going public, that was a way to sort of close that gap between the valuation and what you were thinking it's worth. But anyway, it just pays to turn over a lot of rocks and see what you can find. But like and subscribe so you'll see more videos like this. And once again, this isn't investment advice. This is just me walking through my process. Have a great